All right, good morning, everybody. Thank you so much for opting to spend part of your Saturday morning with the folks at Brio and the folks at Staniland and Associates to talk about concentrated equity and strategies surrounding financial planning and tax planning. We've got Michael Telford and Jean Elliott to start off the program here. And if you have any questions at any point in the program in advance of the breakout rooms, feel free to just speak up. And if you could just mute yourselves until you have a question. Okay, excellent. All right, so with that, Michael, the floor is yours. The virtual floor is yours.
All right, thank you. Hey, good morning, everyone. So I'm Michael Telford. I'm a financial planner here at Brio Financial Group. And first off, we just want to say thank you from us at Brio and at Staniland and Associates for taking the time out of your Saturday mornings to be here and learn about the fun topic of concentrated equity positions. Before we begin, I just want to call out a couple of things. This call is being recorded, so just be aware of that. And also just want to note that we cannot provide specific financial recommendations in this time, and the topics discussed are intended just for informational purposes only. So please consult with either a planner at Brio Financial or your own financial planner or your own accountant or estate planner on questions specific to your situation. We'll be speaking for roughly an hour, and we're going to be covering concentrated equity positions, what that means, why we care, common situations where we see it come up, and then the tax standpoint, the implications and strategies around taxes, and then how it all fits into both estate and financial planning. And then after we cover all of that information, you'll see we'll be hosting a few breakout rooms for questions. And then I just want to take a moment to just go over today's speakers and breakout room leaders and introduce them. From Staniland and Associates, we have Russ Staniland and Alec Harrington. And then from Brio Financial Group, we have Brandon Miller, Jean Elliott, Pam Schmitz, and myself. So again, thank you very much for joining. And I just want to hand it over to Brandon Miller right now just to discuss the state of stocks.
Hi, everybody. So I'm Brandon with Brio. So this, I love this little graphic. I think it quite easily encapsulates a lot of what we hear from our clients. So truly there's this investing, and then there's the entertainment factor, right? And there's this overlap. And this is what you like, the whole GameStop saga that has been happening over the past month or so. If you've like even ever seen a newspaper in the past month, like you've heard about GameStop. This is exactly what we end up seeing all the time. And, you know, 2020 to me was what we keep talking about with clients is how 2020 is this like poster child year of why you should stop thinking when it comes to the stock market, because the markets are, that's not the economy, right? Those two things are not the same, and they're not rational. So don't try and overthink it. There are some very basic, tried and true rules that we always apply when it comes to investing, and so don't overthink it. In 2020, we had no business making money, and yet like the average portfolio was up about 14%. So we try really hard to stay away from specific stock investment. But of course, especially in the Bay Area, many of us end up with lots of company stock, right? Or stock of any shape or form. So story, when I first started as a financial planner, like in the late 90s, as many of you know, that was, you know, we had our .com boom happening then. And being the, you know, green advisor that I was, I spent, I had this very early on client who was an employee at Sun Microsystems. And I was all excited because they had, I don't know, a couple $1 million or something in Sun Micro. And I, of course, knew what the textbooks told me to do. And so I told them that they needed to sell it and all this stuff. And of course, they said, oh, no, we're never selling Sun Micro because that's what made us rich. I'm like, oh, but that's not what you're supposed to do. So, of course, as you can imagine, how that story ended is I failed. as the advisor to get them to sell it, right? Sun Micro plummets. They literally had a tax bill bigger than the value of their stock the following year because they had incentive stock options and the AMT rules and whatnot. So I'm telling you about that early failure because that obviously made a big impact on me. Knowing that what the textbook says to do is often irrelevant, okay? Fast forward decades later, we still have that same issue happening all the time. And I can think about a client that hired us last year. And this round, I'm now a little wiser, a little bit wiser, not much, but a little. I now know, well, one, I'm just meaner, frankly, in my old age. And so I'm much stronger in my conviction. Shannon's shaking her head. I'm much stronger in my convictions of what clients should and should not be doing. But I also realize there's lots of different avenues of getting there. And so I have to meet the client where they are. And so a lot of times what's very helpful to us is if we can start with the bigger picture and integrate financial planning. So Brio is a financial planning firm. We do really well with our strategic planning advice, and money management is a very important part of that, but it is a piece of that larger puzzle. And so a lot of times, like I'm thinking about this client last year who had a bunch of Netflix stock. And if you can show the client what it means in terms of their bigger picture, so you remove them from the emotions of the stock itself and show the impact to their bigger picture and connect those dots for them, now we're usually much better able at moving the needle on what that client can and should be doing with the stock. So at any rate, those are my thoughts.
Thank you for that. And we hope you enjoy these sketches throughout the presentation. They're from The Behavior Gap by Carl Richards, and he just basically does back of napkin little sketches that really get to the point, and they're lots of fun. So hope you enjoy those. And with that, I just want to jump into our presentation about concentrated equity positions. And so the first question we think many of you are probably asking, well, what exactly counts as concentrated? Is it just 100 shares, or is it a certain portion of your net worth? And we actually look at it with two rules. So the first one is the 10% rule. And what this means in our minds is anytime we see a client that holds a single position that makes up more than 10% of their investable assets or their liquid net worth, then we classify it as concentrated. And you can determine that liquid net worth number or your investable assets by taking your overall net worth and then just subtracting out the equity in your home. And so, for example, let's take someone who has $1 million between their 401k and a few various brokerage accounts, like a traditional IRA and a Roth IRA. And they happen to have $200,000 of Tesla inside of it. And that's going to really stand out to us because that's 20% of their investable portfolio all in one holding. So it's definitely concentrated. And that's going to concern us regardless of the holding. It could be Apple, it could be Johnson & Johnson. It doesn't really matter what the stock is. It's just that it represents such a large portion of their portfolio overall. And this concerns us just because of how volatile and risky stocks are. So anytime you're investing in stocks, there's obviously a bunch of inherent risk, even if it's something like a very diversified index fund, like an S&P 500 index fund with almost 500 holdings inside of it. There's a ton of risk, but the amount of risk in one single holding, like Tesla or Apple, compared to a diversified index fund is night and day. So when we diversify, or even better yet, use something like asset allocation-based investing, which we're going to touch on later, we gain some sort of predictability in the long run. And that's important to us as financial planners, because really what we're doing when we're modeling out your portfolio and your situation is we're trying to predict what your portfolio balances will be down the road. And without knowing what they're going to be down the road or having some sort of educated guess, we're not going to be able to tell you how much you can spend or when you're going to be able to accomplish your goals. So it's really, really important to have some sort of predictability there. And Jean will definitely be touching on all of that here shortly. But yeah, so we view stocks essentially as like a lottery ticket. If you're owning just one individual stock, it could either pay off or it could really not, just like in Brandon's example earlier. So let's take Tesla as another example here. In the past 4 months, we've seen it like as low as like $380 or $400 a share, as high as almost $900 a share. And then 2 days ago, I pulled the number and it was like 600 a share. And I just checked again this morning, and yesterday it closed at like 692 or something. So just absurd volatility. It's probably one of the most talked about stocks because of that. And that's a heck of a roller coaster ride for someone to be on that is, has a large part of their portfolio. And it makes it, again, impossible for us to really guess what that portfolio is going to do in the short term and the long term. And there's also the risk that the company that you're invested in, not just that it's going to be really volatile and just fluctuate between like 380 and 880 on a monthly basis or something, but there's also the chance that that portfolio becomes, or that holding becomes, irrelevant or goes under. I think a lot of people think some stocks are too big to fail or too successful to stop being so successful, and that's just simply not true. If we take a look at like the Dow Jones Industrial Average as an example, there's 30 holdings that each of the holdings are like industry leaders in their respective industries. And if we take a look at who's in it today compared to who was in it 30 years ago, there's only 10 companies that are still in it today as in 1991. So those companies, some of them aren't the industry leaders anymore. They're still big names. Some of those companies don't exist at all. And some of the companies that are in it today didn't exist 10 years ago. So there's a lot of movement around big successful stocks. And I think I was actually driving to breakfast this morning, and my wife and I were talking about Quiznos, how we never see Quiznos anymore. And at one point in time, Quiznos was like a massive company. They had chains everywhere, just like Subway. And we looked it up, and they just had the worst luck and made a few poor decisions. And they're like now just a case that is studied from like bad business decisions and just unfortunate chains going under. Sears is another really great example of this. They were on the Dow Jones Industrial Average 30 years ago. They're not today. Their profits actually peaked as recently as 2006, just 15 years ago. They were at their most profitable. Just 4 years later, they were no longer profitable at all. And 8 years after that, in 2018, they filed for bankruptcy. So in just 12 short years, that company went from the best it possibly could be or was to a company that was essentially worthless for its stockholders. So we just want everyone to keep in mind, no company is invincible. It can suffer. Another rule that we take a look at is the 5% rule. So the 5% rule applies specifically to company or clients of ours, or any employee or any investor of a company that not only is an employee and gets their income from it, but also has a lot of holdings. So they're an investor in that company as well. And so let's take the example from earlier, someone with $1 million in investable assets, and they have 200,000 in Apple, for example. So if they're also an employee of Apple, we want that exposure to Apple to be down to $50,000, just 5%. And again, it can be any company, Johnson & Johnson, Google, and Alphabet. It can be any company. We're not trying to pick on Apple or Tesla in this call. But we do take a more conservative approach when someone's an employee, just because not only is their portfolio now heavily reliant on that stock, they're also reliant for income, benefits, retirement, insurances. And that can be scary. And layoffs and falling stock prices tend to go hand in hand. And so the last thing we want is for you to not only lose your job and all of the benefits, but also to have money in your portfolio shrink and not be able to sustain you or help you reach your goals in time. If we plan properly, a layoff situation is just a bump along the way. It's not going to completely derail your life or your plans. So now I want to hand it off to Gene Elliott, now that we've kind of defined how we identify these concentrated positions. And he's going to talk about the common situations where we see it come up for clients, which can be really easy in the Bay Area, and also some of the common reasons that our clients are resisting selling of some of those positions.
Hi, everyone. I'm Gene Elliott. I'm an advisor at Brio Financial Group. Like Michael said, I'm going to take some time to walk through some of the common situations that cause someone to have a concentrated stock position, as well as talk about some of the objections we hear as advisors in case any of these might resonate with you. Perhaps the biggest reason people obtain a concentrated stock position is it's just part of their compensation. Companies, especially in the Bay Area, they often offer employees compensation in the form of stock awards. And like Brandon and Michael both said, we tend to view these as lottery tickets. They might pay off, but they might not. I remember when I first moved to San Francisco in 2005, I was at a house party with friends and I was talking to this woman about what we both did for a living. And she had said, oh, a few years ago, I was a multimillionaire because I had all this stock in the dot-com company she worked for. And then the bubble burst. So she went from being a multimillionaire one day to not being a multimillionaire the next day. I had another client who his lottery tickets hit big last year. I'd been working with him for about 4 years, and we had done financial planning under the assumptions either way. We ran planning without the stock awards, and we ran planning with the stock awards hitting at different levels so we could have an idea of what things could look like, but we were really relying on them not hitting from a planning perspective. And then his company offered a buyback last year and he hit it big. So it didn't work out for that woman that I met in 2005, but it did work out for my other client. So as advisors, it's really important for us to work with our clients to really come up with a best strategy on how to use these stock awards to help them meet their financial goals and also have an understanding of how things could look if they pan out versus how things could look if they don't pan out. When we think about equity compensation, the three common types people receive are stock options. They give us the ability to buy a stock at a fixed price, at a fixed point, regardless of what the stock price is at that point where we can purchase it. The most common may be restricted stock units, restricted stock awards. Basically, the company is just giving you stock, and when it vests, you can keep it or you can sell it. And I'll talk more in the planning section later on today about how we approach these different stock options and awards. The third type is an employee stock purchase plan. That's a really great way to get company stock at a discount. Generally, an employee is contributing to their ESPP, employee stock purchase plan, through payroll deductions. And then at the end of 6 months, they get to buy the stock at a 15% discount. If you think about 15% twice a year, that's a 30% guaranteed rate of return, which is pretty compelling. As I said, I'll talk more about our solutions to these stock awards later on. But another way that people can obtain a concentrated stock position, it's through brand loyalty. We all are loyal to different brands for different reasons. I'm loyal to tech companies and restaurants and clothing companies. I'm also loyal to where I work. I love working at Brio Financial Group. I love our culture, our clients, the people I work with. I am drinking the Kool-Aid. And oftentimes people who work for companies that offer stock as part of their equity, or excuse me, as part of their compensation, they are drinking the Kool-Aid as well. And that can bleed over into our investment habits. Other ways are inheriting a position from a loved one who may have worked for that brand for a long time, or a loved one who held the stock for a long time. And it may make us feel good to hold on to that position because it reminds us of them. That stock was important to someone we loved, and so now it's important to us. Another way we get brand loyalty is we just held the brand for many years. I have a good friend whose uncle bought her Apple stock when she was a kid. And, 30 years later, she still has it in her portfolio. It's not a lot, but it's still there and she's loyal to it because an uncle she loved bought it from her. So there's an emotional attachment there. The final way that I think people really can get a concentrated stock position is if they partake in an initial public offering. And those can be really exciting. We all remember what the world was like before Uber, and we've all had a front row seat when Uber arrived on the scene, and we've seen Uber transition from this startup into this multinational giant company. And so it's really exciting when we follow something for a long time and then they're going public. And sometimes we want to partake in that initial public offering, but we always have to be careful and we always have to understand the risk and be cognizant of how much we're willing to invest because we never know what's ultimately going to happen with the stock. Typically, you pay a premium if you take part in an IPO because all the buzz and excitement drives up the price when it first hits the market. And then things calm down and the price falls and we might lose money. So we always want to be cognizant of that and make sure we have an understanding of the risk and we have a plan in place. Now I'm going to talk about a few common objections that we hear from clients when we start having conversations with them about diversifying out of a concentrated stock position. And as I talked about brand loyalty, that can really cloud our judgment when it comes to investing. As I said, it's tough to let go of something we love or have an interest in. But as Michael said, we have to remember we don't have to let go of all of it. We can keep 5 to 10% or even less with the understanding of the risk that involves and that we may lose half of it or all of it. I remember a few years ago, I had a new client who started working with me and she brought in basically $1 million in Chevron stock. She had inherited from her father. So she had a strong emotional attachment to it. He had worked for Chevron for years. And so we had many discussions about the risk that this position has on her portfolio. And we had discussions about the potential tax consequences. And she agreed to part with almost all of it. And of course, we don't want anyone to be surprised come tax time. So I told her, you're probably going to owe $50,000 a year in taxes on this sale because it had appreciated so much since she inherited it. And sure enough, when I talked to her the following April, she said, oh man, I'm doing my taxes and this really sucks. I hate paying this much in taxes. Of course she does. We all do. But we have to remember we're paying taxes because we made money. And she said, I know we did the right thing, but this really sucks. And it does. But then COVID hit and then the market fall hit in February and March. And when we talked in April of 2020, she said, wow, I am so glad that we sold that because I think that really hit home the risk that I had talked to her so much about in having a concentrated stock position. And now she saw in the remaining Chevron stock what that looked like because what we had left fell quite a bit. So at the end, she was super happy that we did it. And we in fact sold the rest of the Chevron stock. Another thing I commonly hear people talk about when they don't want to part with a position is the performance. There's a fear of missing out on returns if we sell most of our position. That also can lead us to make irrational decisions when it comes to investing. I had another new client start a couple years ago, and in one of our first meetings when we were going through his assets, I said, wow, you have a lot of company stock. And he said, I know. And last year, my CPA told me to sell a bunch of it, and it kept going up. And now I'm really pissed at my CPA. And I said, in fairness, if the price had gone down, your CPA would have been your hero right now. And he said, oh, well, that's a fair point. I didn't really think about that. And again, because he is looking at it from performance only, he is not looking at it from a risk perspective. And we have to remember that since the 08-09 financial crisis, we've been riding the back of a bull market with a hiccup last year, but that's not going to last forever. For a 40-year-old today who lives till 90, it's likely they're going to see at least 5 to 6 periods of a significant market drop over the course of their lives. So we have to always be prepared for that. And we have to always have an understanding of what we need our money for. And again, we'll talk more about that in the planning section later. Lastly, another big argument I hear is about asset allocation. Some people just don't believe in asset allocation based investing because they believe it's too conservative. They don't want to invest in bonds. They think bonds are something their grandparents invested in. But bonds are an important part of our investment strategy because they do provide us with some downside protection. And studies have shown that when a portfolio exceeds 80% in stocks, it really loses its efficiency from a risk reward perspective because the additional reward potential is just not worth the additional risk we're taking on. And so, as I said, I'll talk more about all of this stuff and solutions later on in our financial planning section. But for now, anytime we sell stock, there are going to be tax consequences. And although we don't want taxes to drive the decision, we want to make sure we know what the tax hit is going to look like, and we have a plan in place over time. And when we think about taxes on a concentrated stock position, if we have a tax problem now, that tax problem is probably going to get bigger and bigger over time as the stock appreciates. So this is where working with a tax advisor comes in. A tax advisor can help us understand and estimate the tax consequences so we know what we're dealing with and looking at, and we can plan accordingly. I'm now going to turn it over to Russ. We've worked with Russ for years. He's worked with many of our clients, and he's been a great resource to our clients and us through his expertise in both taxes and estate planning. So he's going to now lead us through a discussion on stock sale taxes.
Hey, Russ. Sorry to interrupt. It's Brandon. But real quick, before you jump into tax stuff, are there questions thus far? I just want to make sure, because I feel like there's been a lot of different things kind of talked about. Does anybody have questions yet so far? All right. Okay. Well, if you do, we are to know that the chat is there. I mean, you can always ask questions that way, and so we're trying to answer questions as we go about. So but don't be afraid to interrupt us as we're talking. Okay. All right, Mr. Russ, take it away.
Thank you. Good morning. I'm a CPA and an attorney, and JD CPA spells tax geek. So that's what I'm going to talk about this morning. And I'm going to start off with capital gain. And that's a big issue. And long-term versus short-term. Long-term capital gains are taxed at a somewhat preferential rate. And there's several different rates. If you're not in the highest tax bracket and you sell stock for a gain, the federal part of that, the federal capital gains rate is 15%. If you're in the highest tax bracket, it's 20%. But then there's also a potential 3.8% tax on it, and California taxes it at your ordinary rates. So if you're in the highest tax bracket and you live in California, your long-term capital gains rate combined, federal and state, is going to be somewhere around 37%. That's that's better than the highest tax bracket for ordinary income, but it's not that great, but it's certainly worth taking advantage of. And long-term versus short-term. Short-term gains are taxed at your ordinary rate. And if you have gains and losses, you can net the two together and only pay tax on the end result, the net, and you can net short-term against long-term. But long-term capital gains are gains on assets that you've held for more than 1 year. Keep that in mind, more than 1 year. So if you bought Tesla stock on March 1st and it's increased in value tremendously and you're getting nervous about the volatility and you want to sell it as quickly as you can and get long-term capital gains treatment, don't sell it on March 1st, 2022. That's exactly 1 year. You have to hold it for more than 1 year. That's a lot of people have fallen into that trap, and I have. It's a painful move. Also, here's a little strategy. If you're in the lowest tax bracket, the 10 and 12% tax bracket, then your capital gains are not subject to tax at all. And a married couple can have approximately $80,000 and be in that lowest tax bracket. And also, qualified dividends are taxed the same as long-term capital gains. So if you are anticipating having capital gains and you are able to manage your income, then put off recognizing any income, recognize $80,000 worth of capital gains in that year, and you will pay no tax on them. Most people are not able to do that. You're not able to manage your income. Some people can. Self-employed people can occasionally do that, but that is a real tax bonus. And I said qualified dividends are taxed the same as long-term capital gain. A qualified dividend is a dividend on stock that you just have to own it for 60 days. And you get long-term capital gains treatment on your dividend, which is very nice. State tax implications. One scenario I'm seeing a lot is my clients know they're going to have a liquidity event. They know that they own stock in a company and it's about to be purchased by another company, and they don't want to pay the California tax. The way to avoid California tax is not be a resident of California, which is more difficult than it sounds. A lot of my clients want to move to Nevada before they sell their stock. And if they can pull that off, they will escape California tax. And the highest tax rate in California is 13.3%. California wants your money and they're not ashamed of taking it. There are countries in the world that don't have a tax rate of 13.3%.
So Ron, can you talk for just like 12 seconds on how do you become a Nevada resident and not have California tax you? Like, how difficult is that?
It's difficult. California considers you a resident using the domicile theory. And your domicile is a place you expect to return to. And some states like New York just have a strictly numeric test. If you're in New York State 183 days during 1 year, you're a resident. And so it is possible to be considered a resident of two different states, of California and another state. And what I tell my clients is sever your ties with California. You can't, the Franchise Tax Board is very aggressive about trying to tax people who claim they're no longer California residents. If you own a home, if you own a residence in California and you just move to Incline Village, Nevada and keep your residence here, that's going to be a problem. You can have rental property in California, but if it looks like your intent really is to return here, then California is going to treat you as a resident and they will come after you. They definitely will. What I tell my clients is, sell your residence. Don't maintain the house that you used to live in. Definitely don't have a country club membership in California. Move to Nevada, change your driver's license, move all of your bank accounts to a Nevada bank. Don't have anything mailed to California. Join a country club in Nevada. And also we leave a very bright audit trail these days with our credit cards. You claim that you've moved to Nevada and you're a permanent resident there and you're audited by the Franchise Tax Board. They're probably going to request your credit card statements. And if they see that, every week you ate in a restaurant in Burlingame, you filled your car up, 40 times during the year in San Mateo, they're going to say you're a resident of California. You spent too much time here. It's obvious that you really, really intend to move back here. I'll say it again, they're very aggressive about that. Okay. The next topic, potential changes under the new administration. I normally, have everything I can handle just trying to be knowledgeable about current tax law, but there are some interesting proposals that the Biden administration has put forward. The biggest one is regarding long-term capital gains. Under Biden's proposal, if your income is over 400,000, then your long-term capital gains would be taxed at the highest ordinary rate, which he is also proposing to raise from 37% to 39.6%. That's a big deal, but a much bigger deal as part of that same proposal is the administration is proposing eliminating what's called the step up in basis. If you inherit property, let me define basis. Basis is important. When you're calculating your gain on sale of an asset, the gain is sales price less basis. And for instance, if you buy IBM stock for $10,000 and you sell it for $15,000, your basis is $10,000. You subtract that from the sales price, your gain is $5,000. However, if you inherit stock or any property, your basis is fair market value on the date of death of the person who left it to you. And that's a big deal. That's been the law forever. And that is so baked into our planning, estate planning, tax planning, that eliminating that step up in basis, which is proposed, is going to be a major hardship on some people. But if you think about it, that is that's a big giveaway, and it's been there forever. People inherit $5 million worth of Microsoft stock from their grandparents. Their grandparents paid $5,000 for it, and they can turn around and sell it the very next day, have a $5 million gain, and not pay any tax at all on it. Well, if Biden's proposal passes, then that's history. And we just had a recent change in the California law. There was a parent-to-child exclusion on real estate for property tax purposes, California property tax, not income tax. If a parent transferred property real estate to a child, the child got the parent's old assessed value for property taxes. And I remember at one point, Gordon Getty in San Francisco was paying less property tax on his mansion than I paid on my 2-bedroom condo. He bought the place next door, so his property tax went up. Property taxes are a public record, so if you want to look up Gordon Getty's property tax, you can. And he's got 14 bathrooms in his house too. That's a lot of cleaning. But, as of February 16th, that that parent to child exclusion no longer exists. And my office got really, really busy between, the law was passed in November in the election. It was an initiative. And my phone was ringing off the hook, and my email was stacking up to the ceiling from clients asking questions on that. I felt so desirable. That's not a feeling that certified public accountants get to experience very frequently. So keep that in mind, that step up in basis is going away. So if you want to take advantage of it now, the problem is you have to die. And dying can be an excellent tax strategy, but I've never, ever convinced a client to do it.
Hey, Russ,
Yeah.
along those lines, I was reading somewhere that not only is it proposed that they're eliminating the step up in cost basis, but that they actually would go ahead and actualize the gain at the death of the decedent. So like in your Microsoft example, not only would, the heirs get the original cost basis, but that they would actually have to go ahead and pay the taxes on the gain at death, which effectively, I'm sure for most people, would mean you actually have to sell the asset, right? Especially if you're talking about like farmland or something.
That's true. Yeah, most people would have to sell some of the asset to pay off the tax, and that is the current law in Canada, by the way. Canada does not have an estate tax, a tax on the value of your assets when you die, but they do have a deemed sale rule. So, it's not very far-fetched. It's not out of the realm of possibility that the United States would also adopt that. Okay. Another big change that's in the works involves Social Security taxes. Right now, you only pay Social Security on the first roughly $137,000 of your income. Under the Biden proposal, if your income goes over 400,000, then that kicks back in. So there's a big donut hole. And if you're the way it works is the employee pays 6.2% Social Security, and the employer pays 6.2%. So it's a total of 12.4%. And if you're self-employed, you're going to pay both of those halves, 12.4%. So if you're self-employed and your self-employed income is $500,000, you would be hit with another $12,400 of tax on top of that. That's significant. That's a big deal. It's the reason that they're proposing that is because Social Security is, it's hurting. They want to make sure that the trust fund has money in it when everybody gets ready to retire. And it's a subject that's near and dear to me. I'll be eligible for full retirement in another 30 years. So I want that trust fund built up, but I don't want to pay on the way. Another proposal that the Biden administration is making is eliminating the qualified business income deduction for people who make over $400,000. I don't know, this $400,000 keeps cropping up. It's a strategic pivot point, apparently. But what the qualified business income deduction is a 20% deduction. You get to deduct 20% of your qualified income. It has to be business income. And, a deduction is an expense. You're supposed to spend money to get a deduction, but this deduction is just 20% of your income if it's qualified income. And there are certain professions that are prohibited from taking this. Doctors, accountants, attorneys, and I'm an accountant and an attorney. Does that mean I have to add 20% to my income? But I don't get to take advantage of this. But the new proposal will eliminate that deduction for anybody making more than $400,000. Okay.
Ross, I think presidents make $400,000 on the dot. So it's anyone who makes more than the president has to get extra taxed.
That is a shrewd observation, Michael. You're exactly right. I didn't think about that. Okay. Well, those are the major, the two really big proposals, and whether they'll pass or not is anybody's guess. The Senate is evenly divided with Kamala Harris as the tiebreaker. There are some rogue senators out there, Joe Manchin, Bernie Sanders. They're always a big question mark. If this is a topic of interest, follow the news in this area. Okay, and equity compensation. And it's a big topic in this area. There's restricted stock units. That was touched on earlier, and there are incentive stock options, and we don't see incentive stock options as much as we used to. An incentive stock option is an option. An option allows you to buy stock, sometime in the near future for a fixed price. And if it's a qualified incentive, normally when you exercise that option, you have income, and it's salary and wages, ordinary income, and your income is the difference between the fair market value of the stock on the date you exercise the option and the strike price on the option. If you have incentive stock options from Tesla, and it allows you to buy the stock at $300 per share, and it's trading for $600 per share, when you exercise, you have $300 of income. With a qualified incentive stock option, you don't have to recognize that income when you exercise for regular tax purposes. I'm going to come back to that. And then if you hold the stock for more than 1 year, when you sell it, all of the gain is long-term capital, taxed at a preferential rate. And I said the difference between the strike price and the fair market value of the stock is not income for regular tax purposes, but it is income for alternative minimum tax purposes. And AMT, alternative minimum tax, is a devious little tax. And there's only about 200 people in the United States that really understand it. I'm not one of them. I hope the guy who wrote my tax software does understand it. But keep in mind, if you do get a qualified incentive stock option, it is potentially subject to alternative minimum tax. Brandon touched on that earlier with his client that had a lot of Sun Microsystem. It is a devious tax, and most people have no idea they're paying it. And non-qualified stock options, those are more common than qualified incentive stock options. And a non-qualified option is just an option to buy the stock. And when you exercise, it is fully taxable. And again, it's ordinary income, salary and wages, and it's the difference between the fair market value of the stock and the strike price. And but one thing to keep in mind is if you are getting equity compensation, if you're given restricted stock units, and there's a limit on transferability or a substantial risk of forfeiture, and a substantial risk of forfeiture is vesting. You have to work there for 3 years. When that restriction on transferability lifts, that is income instantly. And it doesn't matter if you paid for the stock or if it was given to you. There's a case, an old case where in tax court, where an employee went to work for a company, and the company was not publicly traded, but he was allowed to buy stock in the company. and he paid fair market value. They got it appraised, and he bought the stock for 3 or 4 cents per share, but it wasn't publicly traded. And what the law says, it reads, if property is transferred to someone in connection with services rendered, then this rule, section 83 of the Internal Revenue Code applies. And when the restriction on transferability lifts, it's income and it's salary and wages. So this gentleman bought stock for 3 cents a share, and it went public a few years later. And when it went public, his stock was worth about $3 or $4 million, and he didn't sell it. And he had purchased it for fair market value. And the IRS audited, and they said, you have $3 million of salary and wages. And he said, what do you mean? I bought the stock and I haven't even sold it. And the IRS won. And he had to pay tax on $3 million of ordinary income and there is an easy workaround on that. It's called an 83B election. And everybody that has equity compensation should call your tax advisor and say, here's what's happening. Should I make an 83B election? An 83B election is just, when you receive the stock, you recognize the income immediately. And then when the restriction on transferability lifts, or when you're fully vested, it's not income. And when you do sell the stock, as long as you held it for more than a year, all of the gain is long-term capital. So 83B elections are very, very, very important. And a client called me a couple of weeks ago, and it was his fact pattern was exactly the same as that tax court case I just described, except his stock wasn't worth 3 million, it was closer to 100 million, and he did not make an 83B election. And the company is being bought out, and he's about to face a very, very, very painful tax bill. And he's one of my clients that's looking to make his permanent residence in Nevada.
Hey, Russ, sorry to keep interrupting, but real quick, 83B elections, don't you have to elect that within 30 days of grant?
Yes, you do. Important date. You have 30 days after you receive the property to make that election.
And most people don't, they're getting it, especially the larger grants or when you sign up, get hired to begin with. And I just feel like oftentimes with clients that kind of gets lost in the fray. So just for those of you who are working, at some of the bigger tech companies that hand these things out, make sure your colleagues know, like 83Bs have to be done like very early on.
Yes, and back in the 1990s, early 2000, in the first .com bubble, all of the companies were they were holding meetings and trotting in people like me to talk to their employees and tell them about 83B elections. And nobody's doing that anymore. The employees are usually completely unaware of it. So that is a trap for the unwary, definitely.
Hey, Russ, there's a question in the chat that I'm not really sure about the answer for. So with foreign companies, so non-US registered companies, can you do an 83B election for those as well?
Yes, you can. Mm-hmm.
There you go, Patty, yes.
And dividends from foreign companies can be qualified dividends also. They don't have to be domestic corporations.
Okay.
And I believe that is my time.
So before, I don't know, someone else takes over. So some of these other things, these tax and estate strategies, are you going into these now?
Am I going into them now?
No, Michael or Jim?
I can
talk
definitely
a
touch on
little
a
bit
few.
about some solutions.
Okay,
Yeah.
I think we don't have time to really go in depth, but it would be nice just, okay.
Yep, I'm going to touch on some of them. I'm going to take over now. Again, I'm Gene from Brio Financial Group. And now that we discussed concentrated stock positions and common occurrences and roadblocks and taxes, now we need to think about how we're going to best utilize these types of awards to help our clients meet their financial goals. And to do that, we have to have discussions about risk, what timelines we're looking at, and asset allocation and diversification. It is really important that we understand the tolerance for risk that every client we work with has. And so we have to have a lot of conversations with them around risk to help us get there. But the problem can be sometimes they will contradict themselves. I've had clients, for example, tell me that they have a low tolerance for risk, and then they have a large concentrated stock position and they don't want to sell it. And those two things, they don't align with each other. So we have to really dive deep with our clients to really get to uh, what their overall risk is. And as I said before, it's really easy to be positive about the performance of a stock when we're on the back of a bull market. Losing money feels worse than making money feels good. And most of the time we're making money in the markets, but as we've seen in the past and we saw last year, there's times where the market falls as well. So we have to first really look at the timeline we have in front of us for our various goals. When we look back at the history of the market, since the Great Depression, the two longest recovery periods were the dot-com bubble burst in the early 2000s. It took about 2 years for people's accounts to recover. And in comparison, the second longest recovery period was the 08-09 financial crisis. And although that was a lot worse than the dot-com bubble burst, the recovery period was shorter at 18 months. So we generally think a recovery period can take up to 2 years. And when you look back at the 08-09 financial crisis, it was a retirement delayer or destroyer for some. For people that didn't work with financial advisors or they didn't work with good financial advisors, they had portfolios that weren't allocated appropriately. They were too risky. For example, you're gearing up to retire and you have $2 million saved, and now the 08-09 financial crisis hits, the market falls, and your $2 million turns into $1.4 million. Well, now we have no choice but to delay our retirement and wait until our accounts rebound. And that happened to people in 2008 and 2009. And it's not just about retirement. It's about our full financial plan. It's about all our goals. Different goals are going to have different timelines associated with them. And therefore, the level of risk we can apply towards funds for those specific goals can be different. So for goals we're trying to meet within the next 2 years, it really is more about preservation than growth. So it makes no sense to consider our $200,000 that we have in Google stock as a down payment on a home for a year from now, because in a year that 200,000 could drop. And now we don't have the money that we intended for a down payment when we wanted it. So we have to wait longer. If we're looking at more midterm goals, 2 to 5 years, we can inject a little more risk. Although it may be about preservation, there might be a lean towards growth. And so we can inject a little bit more risk to try to enhance the returns. And then when that 5-year timeline shrinks down to 2.5 years, we start putting a plan in place to move out of that and into something more safe. If we're looking at really long-term goals where we have a really long runway in front of us, and for someone who's 30, we're talking retirement accounts here, certainly, and maybe non-retirement accounts if their intent is to be used for retirement. we have a really long runway in front of us. So then it becomes more about growth. So we can inject even more risk into the portfolio. So it's really important. And that's why we do holistic financial planning, is because we want to understand all our clients' goals, who they are, what their dreams are, and what they're looking to achieve, so we can make their income and their assets work for them in the most efficient way. And one way we do that is with diversification and asset allocation. If you think about a concentrated stock position, your risk and your reward, it's tied to the performance and financial health of one company. And that's where diversification and asset allocation comes in. It helps us shift the risk from one company to hundreds, if not thousands of companies. If you look at a portfolio breakdown, we have all the asset classes: bonds, large, mid, small stock, international stock, commodities, real estate. So that is, in short and in simple terms, what a diversified portfolio looks like. And if we own 100,000 in Salesforce stock, we can diversify into that type of portfolio. And then within the large cap growth stock sector of that portfolio, we have a large cap growth stock mutual fund or ETF. It's a basket of stocks. So now we own a tiny little bit of Salesforce rather than 100,000 in Salesforce. So we diversified our risk, but we still have the growth potential that large cap growth stocks have. And when we look back at what happened in 2020 with COVID, I mean, whoever thought a viral pandemic would hit the world and create such havoc in the economy? And we look at travel and entertainment industry stocks and what a big hit they took last year, because we were all on lockdown and people weren't traveling. They weren't going to movies. They weren't going to the theater. In 08, 09, although everything took a hit in 08, 09, people were still doing those things. Maybe people that weren't working. I was one of those people. I wasn't traveling as much during that time, but people were still traveling. They were still, going out for entertainment. So different market and economic conditions impact different sectors. And we can never predict ahead of time what's going to come and how it's going to impact different sectors. So diversification is really important, because when one or more sectors are falling, hopefully we have other sectors that are not, that help offset those losses. So it is really important that we understand the risk tolerance so we can create diversified portfolios based on those risk tolerances and time frame. When we think about solutions, and Russ touched on some of these, and as Brandon said, I'm not going to go into great detail for the sake of time, but this is really where working with a financial advisor like me or Brandon, or a tax advisor like Russ is really imperative, because you want to have a team of professionals that can assist you with financial planning, investment strategies, and tax strategies. It's really paramount to put that team together. Earlier, I touched on the different types of stock awards that people receive through their employers. Now I'm going to take just a few moments to talk about our general strategy around them. So when we look at restricted stock units, restricted stock awards, I look at those as a bonus paid in the wrong form. It is cheaper for a company to give you stock as part of your compensation than it is for them to give you cash. And if I had a client come into my office and they brought a $50,000 check, said, I just got a bonus, what should I do with it? I would never recommend that we put all 50,000 in a single stock. That's too risky. So the same applies when those RSUs vest. Why would we hold them? They're too risky. So in general, I'm going to tell clients to sell the RSUs and then we're going to repurpose them and get them working towards their goals in a way that we can manage the risk as well as take advantage of future growth, depending on what the goal is and the timeline. With an employee stock purchase plan, I really have the same thought I do with RSUs. Again, you're getting that 15% discount twice a year, which equates to a 30% guaranteed annualized rate of return. You're not going to get that anywhere else. So let's not get greedy. Let's sell, repurpose, and diversify to meet our goals. With stock options, the answer here is not nearly as simple, in my opinion, as it is with RSUs and an employee stock purchase plan. Options have leverage, and we have to consider that. So one way we work with clients to come up with an option strategy is by doing a Black-Scholes calculation. And in really short and simple terms, what that does is it helps us illustrate how the change in value of the stock price can impact the value of their options because of that leverage. And it really helps us come up with the best overall strategy for liquidating our stock options to take full advantage of the leverage and benefits associated with them. Other things we can do, and again, Russ touched on them, is we can do reverse dollar cost averaging, where we sell little pieces of the concentrated stock every month and diversify it. We can tax lost harvest when opportunities present themselves, so that we've sold things and realized losses that we can carry forward to subsequent years to offset gains, or use them in the same year to sell a concentrated stock position to offset gains. Oftentimes when employees own stock, they're subjected to blackout periods where they can't sell their stock due to insider trading rules. Some companies offer what's called a 10b5-1, and an employee can elect to participate in that, and then their stock is automatically going to be sold at certain points, whatever the market's doing. Once they sign up, it's done, and they might have the opportunity to change their mind later, but that allows us to get out of the stock during blackout periods. Russ talked about the 83B election. We also can look at option strategies to help us hedge our bets and maybe make some money in the meantime. For multiple people who own a concentrated stock position, they can get together and do a concentrated stock fund. If I have 100,000 in GE stock, and Brandon has 100,000 in Coca-Cola, and Pam has 100,000 in McDonald's, we can come together and create a fund to help mitigate that risk, because now we're all partial owners of all those stocks. With retirement plans, if you have stock in a retirement plan, we can do what's called net unrealized appreciation, and NUA, which helps us get the stock out of the retirement plan in a tax efficient way. And then lastly, we can look at gifting strategies. We can gift to charities through a donor advised fund. We can also gift to family members who are in lower tax brackets. So when they sell it, the tax hits a lot less to them than it would be to us. So again, it's really important when someone is getting stock awards that they put a financial and tax team in place to help them navigate everything, so we can really take maximum advantage of these benefits. I am out of time, so we do hope you found this presentation informative and helpful, and we're now going to move into our breakout sessions, and we'll answer any questions that you all might have. So please join the session that is most appropriate to you. Brandon and Pam will be talking about behavioral finance tips. Alec Harrington will be handling estate planning questions. Russ will be handling tax strategies, and Michael and I will be handling concentrated equity strategies. Thank you.
And if you don't want to join any of the breakout rooms, you're welcome to hang out here. The remainder of the Brio staff will be here to chat about more general stuff. And Jesse is going to initialize the breakout rooms here. You should have, if you click on your more on your menu at the bottom, if you don't have it showing already, click there for join breakout room and pick the best room for you.
More. Where's more?
Next to reactions, next to leave.
Oh, I don't have that.
How about breakout rooms?
Yeah, if you have breakout rooms.
I don't have that.
I don't have that either.
Okay, maximize your screen. It
Yep.
should, it's next to reactions.
Yeah, I have record on one side of reactions and nothing on the others. Oh, now it says join breakout room. Sorry.
Okay.
I still don't see anything.
Okay, do you see the ellipses where there is more? And then if you hover over that, it says join breakout room.
Okay, hold on. Let's see.
It depends on how you have your screen formatted.
Set up. Yeah.
If you maximize your screen
Mm-hmm.
to be full screen, you
Yep.
might see it at the bottom as an option standalone, but otherwise it's going to be under the more ellipses option.
Okay, well, don't seem to be able to see it. It's kind of strange.
Should be,
It's because I need to hang out with you, huh?
I guess so. All right, yeah, Paula's having problems too. You can't click on one and nothing happened.
Huh.
Which one are you trying to get into, Paula? Behavioral, okay. Can you take, and if you just want to tell us, I believe Jesse can migrate you to whichever room you want.
I was trying to
Yeah,
go to
Paula
the
should have
state
received a
ones.
notification.
I was trying to go to state planning.
Okay, so
Yeah.
can
And
you take
that's-
Patty to estate planning?
Sure.
Thank you.
You should receive a notification in just a second.
Okay, and Janet would like to go to estate planning.
Can you go back to what the options are?
Yeah, we've got behavioral finance, estate planning, tax strategies, and concentrated equity strategies. Okay, David would like to go to behavioral,
Can you take me to behavioral as well, please?
as would Anne.
Thank you.
It.
Okay, and we have Matthew, I believe his father, and another participant remaining in the room. Well, hello, Mr. Beck.
Looks like they joined Michael and
Okay.
Jean's room.
Okay. And Jose, was there anything we could do for you this afternoon? Okay.
Way to chase him away, Shannon.
Well, I just want to know who he is. All right, well, that's weird. I don't know why it didn't work for everybody, but much better than last time. So
Yeah.
improvement.
I mean, the challenge is, that you just don't know what device they're on, what browser they're using, and it can be many
Yeah.
things.
Gene, however, I didn't expect to be our primary problem.
Come on, think about it.
Oh dear. Okay.
How
All right,
many
so
do we have?
29.
29.
Yeah,
good
so
size.
there are only a few no-shows from those who RSVP'd. So it's kind of irritating a little bit, but it happens. All right, so Jesse, what do you mean? You don't know what time Alex's appointment is?
I haven't asked.
What, is she not there?
She is.
Okay. All right. You do you.
Hey, Jesse, where are you?
He's at Alex's house over in Berkeley.
I sent the text. I did ask when
Okay.
you texted me.
His lady friend.
She's on a call right now too.
I was wondering, there's such good light coming in.
I know, isn't it nice?
Oh yeah, I know the skylights are beautiful in here.
Yeah.
And she's thinking of moving, you said.
Yeah, I don't know why.
Well, the commute
I
to
don't.
school.
Yeah. But I mean, all things considered, I mean, just look around.
No, I mean, foolish, particularly when you're going to, I mean, oh, is she going to Hastings?
Yeah.
Yeah, so she's
Yeah.
going to the
So that's
Tenderloin. Yeah.
Mm-hmm. She likes to commute though. I mean, but who knows what that's going to look like when things,
I
open
know.
back up officially again,
I know. I'll tell you, the bus now, I took the bus, I went to Randall's show last weekend, and the gallery is in the Bayview. And
Yeah.
I took an Uber there because I was running late, but I ended up taking the bus back because the 19 it was like a block and a half away. It was no brainer. Save the money, take the bus.
Mhm.
And I was so at the end of the line that there were only 2 other people on it. I'm like, this is okay. And then we passed the food bank, and I'm not exaggerating, about 20, they happen to all be Asian women with their wheelie bags stuffed with vegetables that must have been like, because it was kind of early in the day still. They'd gone to the food bank and gotten their food, and the bus was like not only filled with people, like arm to arm, but produce. And I was like, oh my God, like total anxiety. Yeah, total anxiety. And I've got the dog, and it's just a whole.
Oh, poor Mac.
I know. He was
He's in his courier, like, what's going on?
I know. I had to drug him because I thought there were going to be other dogs at the show. So I drugged him. So he was very, very low energy, which was perfect.
Were there other ones?
No, because I got the date wrong. It's today. Today's the Metville benefit where all the dogs are going to be there.
Oh,
I
do you
know.
plan to stop by again, or
No.
have you seen what you wanted?
I know it actually worked out perfectly because, he gave me a walk through the entire show. He took some pictures of me and of Mac.
Yeah, you probably wouldn't get that same experience with
no, not at
Muttonville going on.
So it was really, I'll send you this picture he took of Mac because part of, I don't know if I shared the picture, part of his, his show is about this dominant submissive couple, and it's called Domesticated, like Dom-esticated.
Okay.
And it's a Dom lady, and she wears these bunny ears. And so he had like some fake bunny ears. Well, not fake, but like not S&M bunny ears. Oh, sorry, Russ. But here's a picture of Mac wearing, the photo booth bunny ears. Nobody wanted to talk about tax strategies?
No, my feelings are hurt.
Oh man, that's just because you did such a great job during the presentation. There are no questions left unanswered.
I covered the entire Internal Revenue Code in 30 minutes.
Oh gosh. So when does it slow down for you, if at all? June?
Yeah, it starts to slow down in early May, but we stay pretty busy most of the year.
Yeah.
November and December are usually a little slow.
The calm before the storm. Yeah.
Yeah, it was sure nice last year when we had until July 15th.
I know, right? Oh gosh.
I do that every year.
I'm kind of surprised there isn't any extension this year, even a little one.
Yeah. In prior years, all of the 1099s were supposed to come out by January 31st.
Right.
And now it's the end of February. So that, we lost 4 weeks of tax season when they did that. It really, really compressed it and made it extremely difficult.
Yeah.
And, everybody can get an extension. But it's an extension to file, not to pay.
Right.
But there are a lot of people who they're thoroughly convinced if they request an extension, the IRS is going to come down hard on them and audit them for the last 20 years. Got to get it in by April 15th.
Yeah. Yeah. Well, I think it's just hammered into you from such, from your earliest of tax paying days.
Yeah. But they've changed the law so much and made it so incredibly complicated now.
Well, and it was complicated to begin with. I mean, it's not.
Yeah. That job Tax Cut and Jobs Act in late 2017 was just a killer. That really, really, really complicated things. And it was a lot of it was badly drafted law too. Very badly drafted.
Well, and it seems they always just try to rush that stuff through.
Oh yeah. There's one that the section on qualified business income deductions. I think that's one of the ones that they tried to jam through at 4 a.m.
Mm-hmm.
If they just waited till the next day and gotten one of the senator's reasonably intelligent 12-year-olds to draft, we would have had a better law.
Oh gosh. Well, sad but true. Well, we're so thankful to have you knowing all that you do and sharing it with us.
Oh,
so thank you.
I'm happy to talk. I like to talk about taxes.
Yeah. And so is this a COVID stash?
Oh, the remnants of my quarantine beard.
Okay. The beard went, but the stash is staying.
Yeah.
Gotcha.
Yeah. When I had the beard, everybody tried to give me quarters on the street.
No, I would have kept the beard. But then you'd have to report it as income, huh? So it'd be a whole thing.
Yeah. Alec is doing a breakout room, isn't he?
He is, yeah. He's doing estate planning.
Oh, okay. Well, I guess everybody wanted to talk about estate planning and not taxes.
Oh, looks like one person is.
Hey guys.
Hi, Julia.
Oh.
Is Russ still around?
He is.
Yes.
He'd love to field a question.
Oh, is he here?
Yes, I'm here.
Super. Sorry, you're on my phone, so I don't see all of the people's faces.
Sorry, nobody
hi,
came to my
Russ.
breakout room.
I was just late. I went to the wrong one, but I had questions about AMT.
Sure.
And the horrendous amount of it that I'm going to be paying for 2020. And I'm curious, what happens next? So I have this really disgusting sum of money that I'm going to be giving the government. How do I use that in the future to make sure that I don't double pay?
Well, what caused the AMT in your case? Was it?
I left a company that I had a lot of options in, and so I had to exercise them all.
Oh, okay. And they were qualified ISUs?
I think they were qualified RSUs.
Well, without knowing more about your individual situation, what will happen is you'll get an AMT credit that you can carry forward, and it will possibly reduce your taxes in future years.
So what does that come in, like a gift certificate from the IRS?
No, it's you should have someone who knows what they're doing prepare your taxes, and you'll have a carry forward. So if you you want to make sure your accountant understands that carry forward. And if you change accountants, you want to make sure the new accountant is aware that you have this carry forward. I don't think you should have H&R Block do the return this year.
No, I will not.
Or your brother-in-law.
But I have, well, you don't know my brother-in-law. Actually, I don't have a brother-in-law.
No.
But what was I going to say? Oh, yes. I already paid AMT like 3 years ago or something, which also doesn't make sense to me. It wasn't a ton, but I've like I said, did not get a gift certificate from the IRS.
No. Well,
how do I find my carry forward?
Look at your returns look at your return for the year that you paid the AMT, and then look at each subsequent year. And I can't remember the form number, but you should be able to track it that way, or your accountant should be able to track it.
Okay. So I should just send my accountant on a mining mission.
Yes.
Yeah. Ask Aubrey to look at that for you and just send her your old return.
Yeah.
Hi, Julia.
Hi, Pam.
Hi.
Sorry, I'm not on video, folks. I'm like a little bit.
Just to paint the picture for you all, Julia is rocking the Wahine look in Hawaii. So, so you're probably doing us a favor to
yes, absolutely. We don't want to see you till you're back stateside.
Oh no, okay. Now that you say that.
Oh no, oh, I see how it is.
It's a cold, rainy day here.
Oh, I don't believe
I'm wearing a beanie. No, it's true.
Oh, poor Julia. All right. Did everyone get what they needed out of their breakout rooms? Because we are here for additional questions if you need them while we have the staff on hand. Otherwise, we want to thank everyone for joining us today. And we've got another educational event coming up at the end of the month on a Friday, 12:30. It's our Brio's Donna DeSanctis. We'll be talking about women and wealth. And I know at least 1 or 2 people here on the call have already indicated they'll be coming to that. So looking forward to seeing you lovely ladies at the close of the month. And with that, invite you to, as always, email us or reach out to us with any of your questions or concerns on how we can help your planning journey be a safe and fruitful one. All right. So thanks from all of us at Brio, and happy weekend.